Moonlit sky, slow-motion grass blade drifting upward. Imagine pulling a single blade of grass from the ground and launching it toward the moon. Not to reach the moon, but to understand where it will eventually fall. Back to the earth. Back into the cycle. Back to feed whatever grows next. That image captures how many individual stocks live and die. Old financial books stacked on a table. Michael Burry describes studying decades of market history, physical stock guides stretching back to the late 1960s. Page after page filled with company names that once mattered and are now forgotten. If markets feel permanent, history disagrees. S&P 500 charts slowly shifting over time. Since 1990 alone, hundreds of companies have rotated in and out of the S&P 500. Many leaders of past eras vanished quietly. Even among elite technology companies at the peak of the dot-com boom, nearly half eventually collapsed, were acquired, or lost the majority of their value. Capital does not stay still. It moves, it recycles. Minimalist macro animation, arrows rotating through companies. This leads to a surprisingly simple truth. For most investors, the safest path is not picking individual winners. It is owning the index itself. The index evolves. The index replaces failure. The index keeps compounding while individual stories fade away. Young person walking outdoors, sunlight, calm pace. If someone is young, with decades ahead, Burry suggests a straightforward approach. Invest primarily in broad stock indices like the S&P 500 or NASDAQ 100. Reinvest dividends. Let time and compounding do the heavy lifting. Live life. Focus on real achievements. Let the system work quietly in the background. Not necessarily today, but over time. Dark shift in tone. Solitary figure in shadow. Yet, not everyone wants easy. Some investors feel pulled toward complexity, toward situations others avoid. For those people, markets occasionally deliver something unusual. A moment that demands conviction. Subtle GameStop-style retail trading imagery, neutral tone. Burry reflects on his own path. A career built on difficult trades rather than comfortable ones. Some worked, some failed. Avanti succeeded. GameStop became legendary. Others did not survive. But the pattern remains the same, returning again and again to the difficult path. Because the next opportunity often grows from the lessons of the last. Without one trade, there might never be another. Close-up of handwritten notes. This is not advice to abandon simplicity. It is a reminder that markets contain two parallel truths. Most people benefit from broad exposure and patience. A small minority choose the harder road, searching for situations that feel misunderstood or ignored. And history shows both paths exist at the same time. Fade slowly to black. Capital moves. Companies rise and fall. Indices endure. And somewhere between simplicity and complexity, each investor chooses their own trajectory. Early 2000s tech office footage, dim lighting. Third quarter of 2001. A company called Avanti caught his attention. He called it Avanti. The firm built advanced software used to design semiconductors, tools that engineers relied on to create the chips powering modern technology. But the story wasn't clean. News headline visuals, legal documents, courtroom silhouettes. Executives were convicted of stealing source code from a competitor. Several leaders went to prison. Investors fled. The stock collapsed more than 80%. To most people, it looked radioactive. To a contrarian investor, it looked interesting. Phone call imagery, engineers working at computers. Instead of reacting to headlines, Burry started calling industry contacts. Engineers at major chip design companies confirmed something important. The products themselves were still among the best in the industry. Apollo, Astro, the Milky Way database. The technology was strong, even if the leadership had failed. Old Microsoft Notepad screen typing animation. His research wasn't glamorous. No fancy tools, no polished presentations, just free-form notes typed into Microsoft Notepad, reading filings, reviewing conference calls, tracking cash flow, looking for reality beneath the narrative. financial charts showing free cash flow metrics. What he found was simple. The stock price had fallen so far that it traded near the value of its free cash flow. In other words, investors were paying very little for a company still producing valuable technology. That disconnect mattered. He began buying. Phone call, graphic transitioning into business meeting silhouette. He even reached out directly to the company's CFO and arranged discussions involving financing possibilities. Not because the trade was easy, but because the numbers suggested opportunity hidden beneath controversy. TV news clip aesthetic, short seller commentary. At the same time, a well-known short seller publicly argued against the company. The media narrative suggested the decline would continue. From the outside, it looked like the skeptics were winning, but his thesis had nothing to do with short interest. This wasn't about fighting a crowd. It was about value. Buying industry-leading products at a price that ignored their cash flow. Quiet office, writing a letter. He shared the idea with a trusted friend and fellow investor. Not as hype, not as certainty. Just another step along a path that rarely feels comfortable. Because the trades that shape a career often begin in moments when confidence is scarce and headlines feel loudest. Fade to black. For most investors, the index remains the easier road. But for those who refuse easy, the search continues. Archive footage, empty trading floor, slow reopening visuals. In late 2001, markets were trying to recover. The shock of September 11th had temporarily shut them down, and uncertainty still hung in the air. During that period, Burry documented his thinking in an annual letter, a snapshot of how he viewed risk, opportunity, and recovery at the time. Corporate merger animation, two logos blending. Eventually, Avanti was acquired by Synopsys in a stock deal worth just under $1 billion. That acquisition carried consequences far beyond the moment. Because through that deal, Synopsys inherited a stake in a semiconductor manufacturer known as SMIC. Modern semiconductor factory footage, glowing circuitry. Years later, SMIC's market value expanded dramatically. Today, its valuation reaches tens of billions of dollars. That original stake, once tied to a company investors abandoned, would now represent enormous value. Minimalist numbers animation. Growth over time. Burry recalls buying Avanti when the company's total value in the market was roughly $100 million. A tiny fraction of what the connected assets would eventually represent. If every share received through the acquisition had been held, the position could have grown into hundreds of millions of dollars. Not a short trade. Not a quick win. A chain reaction that could continue compounding for decades. Duopoly visual. Two towering companies facing each other. Today, the semiconductor design software industry is dominated by two major players. Synopsys and Cadence. A powerful duopoly controlling essential tools used to design modern chips. And yet, at the bottom, Avanti had been priced as if it were finished, trading for less than a year's free cash flow. Slow cinematic transformation, dark frame turning to bright skyline. What once looked broken became essential. What investors avoided became central to a growing industry. The trade was never a discarded cigar butt. It was a transformation story, a company written off by the market that quietly evolved into something far greater. Fade slowly to black. Sometimes the market's greatest mispricing is not about collapse. It is about time. Scrolling stock screener interface, dim office lighting. Fast forward to 2018. Running through lists of potential opportunities, a familiar pattern appeared. GameStop. At first glance, it looked like a company that should have disappeared years earlier. And yet, it was still standing. Retail storefront footage fading into gaming consoles. Digital downloads and PC gaming had been threatening the business for years. But one force kept it alive: the console cycle. The previous wave of gaming consoles had peaked around 2014. The next generation was expected around 2020. That gap created pessimism. And sometimes, pessimism creates mispricing. Options trading screen, glowing numbers. Even early on, something unusual stood out. GameStop's options activity was intense. At the time, it was only a small detail. but later it would matter far more than anyone expected. Quiet family home silhouette, subtle personal tone. The discovery wasn't dramatic. No grand speech. No instant conviction. Just a quiet question. Why hasn't this company disappeared yet? Soft transition. Portrait of analyst working at a desk. Around this time, Burry worked closely with his only analyst, Joe. Joe had once joined the firm as a chemical engineer, then stepped away to study law, determined to become a stronger investor. During law school, he faced an aggressive brain cancer diagnosis. Through surgery and relentless determination, he completed school at the top of his class. Years later, despite ongoing treatment, he continued analyzing markets alongside Burry. Joe remained skeptical about GameStop, and that skepticism mattered. Financial spreadsheet visuals. Looking deeper, the numbers told a complicated story. The company still generated significant cash flow, hundreds of millions in owners' earnings over multiple years. It held substantial cash on the balance sheet, while its overall market value remained relatively low. Brokerage firms speculated about a leveraged buyout, another possible catalyst. AT&T storefront imagery dissolving into cash animation. GameStop was also preparing to sell Spring Mobile, a large chain of wireless stores. The sale could inject significant cash into the company. More cash meant more flexibility, potential share buybacks, operational breathing room, investor notebook visuals, cautious tone. Even with these factors, conviction was not absolute. Inventory levels looked concerning. Industry trends remained uncertain. So the position stayed small, early, but cautious. Cash balance rising animation. Later that year, the Spring Mobile sale brought in hundreds of millions in cash. Inventory liquidation boosted liquidity even further. Suddenly, the company held cash approaching the value of its entire market capitalization. For a value investor, that detail mattered. A company trading near the amount of cash it held suggested the market might be ignoring something. Fade slowly to black. Still, the thesis was incomplete. The catalysts were only beginning to form, and the real story had not yet arrived. Scrolling stock screener interface, dim office lighting. Fast forward to 2018. Running through lists of potential opportunities, a familiar pattern appeared. GameStop. At first glance, it looked like a company that should have disappeared years earlier. And yet, it was still standing. Retail storefront footage fading into gaming consoles. Digital downloads and PC gaming had been threatening the business for years. But one force kept it alive: the console cycle. The previous wave of gaming consoles had peaked around 2014. The next generation was expected around 2020. That gap created pessimism. And sometimes, pessimism creates mispricing. Options trading screen glowing numbers. Even early on, something unusual stood out. GameStop's options activity was intense. At the time, it was only a small detail, but later it would matter far more than anyone expected. Quiet family home silhouette, subtle personal tone. The discovery wasn't dramatic. No grand speech, no instant conviction. Just a quiet question: why hasn't this company disappeared yet? Soft transition. Portrait of analyst working at a desk. Around this time, Burry worked closely with his only analyst, Joe. Joe had once joined the firm as a chemical engineer, then stepped away to study law, determined to become a stronger investor. During law school, he faced an aggressive brain cancer diagnosis. Through surgery and relentless determination, he completed school at the top of his class. Years later, despite ongoing treatment, he continued analyzing markets alongside Burry. Joe remained skeptical about GameStop, and that skepticism mattered. Financial spreadsheet visuals. Looking deeper, the numbers told a complicated story. The company still generated significant cash flow, hundreds of millions in owners' earnings over multiple years. It held substantial cash on the balance sheet, while its overall market value remained relatively low. Brokerage firms speculated about a leveraged buyout, another possible catalyst. AT&T storefront imagery dissolving into cash animation. GameStop was also preparing to sell Spring Mobile, a large chain of wireless stores. The sale could inject significant cash into the company. More cash meant more flexibility, Potential share buybacks. Operational breathing room. Investor notebook visuals, cautious tone. Even with these factors, conviction was not absolute. Inventory levels looked concerning. Industry trends remained uncertain. So the position stayed small. Early, but cautious. Cash balance rising animation. Later that year, the spring mobile sale brought in hundreds of millions in cash. Inventory liquidation boosted liquidity even further. Suddenly, the company held cash approaching the value of its entire market capitalization. For a value investor, that detail mattered. A company trading near the amount of cash it held suggested the market might be ignoring something. Fades slowly to black. Still, the thesis was incomplete. The catalysts were only beginning to form, and the real story had not yet arrived. Scrolling stock screener interface, dim office lighting, fast forward to 2018. Running through lists of potential opportunities, a familiar pattern appeared. GameStop. At first glance, it looked like a company that should have disappeared years earlier. And yet, it was still standing. Retail storefront footage fading into gaming consoles. Digital downloads and PC gaming had been threatening the business for years. But one force kept it alive: the console cycle. The previous wave of gaming consoles had peaked around 2014. The next generation was expected around 2020. That gap created pessimism. And sometimes, pessimism creates mispricing. Options trading screen glowing numbers. Even early on, something unusual stood out. GameStop's options activity was intense. At the time, it was only a small detail, but later it would matter far more than anyone expected. Quiet family home silhouette. Subtle personal tone. The discovery wasn't dramatic. No grand speech. No instant conviction. Just a quiet question: why hasn't this company disappeared yet? Soft transition. Portrait of analyst working at a desk. Around this time, Burry worked closely with his only analyst, Joe. Joe had once joined the firm as a chemical engineer, then stepped away to study law, determined to become a stronger investor. During law school, he faced an aggressive brain cancer diagnosis. Through surgery and relentless determination, he completed school at the top of his class. Years later, despite ongoing treatment, he continued analyzing markets alongside Burry. Joe remained skeptical about GameStop. And that skepticism mattered. Financial spreadsheet visuals. Looking deeper, the numbers told a complicated story. The company still generated significant cash flow, hundreds of millions in owners' earnings over multiple years. It held substantial cash on the balance sheet, while its overall market value remained relatively low. Brokerage firms speculated about a leveraged buyout. Another possible catalyst. AT&T storefront imagery dissolving into cash animation. GameStop was also preparing to sell Spring Mobile, a large chain of wireless stores. The sale could inject significant cash into the company. More cash meant more flexibility. Potential share buybacks. Operational breathing room. Investor notebook visuals. Cautious tone. Even with these factors, conviction was not absolute. Inventory levels looked concerning. Industry trends remained uncertain. So the position stayed small. Early, but cautious. Cash balance rising animation. Later that year, the spring mobile sale brought in hundreds of millions in cash. Inventory liquidation boosted liquidity even further. Suddenly, the company held cash approaching the value of its entire market capitalization. For a value investor, that detail mattered. A company trading near the amount of cash it held suggested the market might be ignoring something. Fade slowly to black. Still, the thesis was incomplete. The catalysts were only beginning to form, and the real story had not yet arrived. By early 2019, activist investors began pushing GameStop's leadership. Letters arrived demanding strategic change. Burry had also urged the company to buy back shares, but with most expected catalysts already playing out, he exited the position during the second quarter. The stock's persistent weakness felt puzzling. Good news appeared, yet selling pressure never stopped. Rather than fight uncertainty, he stepped aside with only small losses. Sharp stock drop animation. Then came June 2019. Disappointing earnings sent the price crashing. Confusion around the company's cash balance added to the panic. Just days later, GameStop announced a modified Dutch auction, an unusual buyback allowing shareholders to tender shares within a price range. The move reignited interest. Simple diagram showing Dutch auction mechanics. In a Dutch auction, investors submit prices they are willing to sell at. The company then chooses the lowest price capable of repurchasing the targeted number of shares. It was aggressive, but perhaps not aggressive enough. Quiet office, investor writing notes. Burry expected the stock to weaken after the tender. And it did. The price drifted lower, exactly as anticipated. But something new was forming. Financial detective visuals, magnifying glass over spreadsheets. A fresh thesis emerged. The company still held significant cash, more than $500 million, while its total market value hovered near $400 million. He began examining every detail. Real estate holdings, operational expenses, even the corporate jet, searching for hidden value or unnecessary costs. Short interest meter rising dramatically. One factor stood out above all. Short interest had climbed to extreme levels. A large percentage of the company's shares were being bet against. If management committed to larger buybacks, the supply of available shares could shrink rapidly. That possibility changed everything. GameStop storefront footage, observational tone. To ground the analysis in reality, he visited a store himself. The experience was uninspiring. Products felt stale. Even items not discounted looked like they should be. The operational problems were real. But sometimes value emerges not from perfection, but from imbalance. Calendar turning to July 2019. On July 15th, he began buying again, aggressively. Volume surged through the market that summer. Shares changed hands at unusual speed. To him, that turnover hinted at deeper forces beneath the surface. Letter writing visuals. Later that month, he wrote directly to GameStop's board. The message focused on one idea: use the market's liquidity to repurchase a large portion of the company quickly. He believed his reputation might help the suggestion gain attention. Soft, respectful transition. Candlelight. Then, tragedy struck. Joe, colleague, analyst, and close friend, passed away after a long battle with cancer. The loss changed the rhythm of everything. Train or highway travel imagery, reflective mood. Days after the funeral, returning to his desk, he resumed buying shares. Not impulsively, but with renewed focus. Inbox filling with emails, SEC rulebook visuals. The public letter drew a wave of messages from other shareholders. Most went unanswered. U.S. securities law makes coordination between investors complex, and even informal collaboration could trigger regulatory consequences. Among those messages was one from a retail trader named Keith Gill. At the time, he was just another email in a crowded inbox, and it was ignored. Only years later, during investigations, would the identity behind that message become clear. Fade to black. The position had grown larger. The thesis had evolved. And the stage was quietly being set for something far bigger than anyone expected. Dark YouTube interface, early live stream aesthetic. A month after his renewed buying, unknown to him at the time, Keith Gill began posting online under the name Roaring Kitty. Videos outlining a bullish thesis on GameStop appeared quietly in August 2019. Two very different approaches, moving toward the same company. Boardroom letters stacking on screen. Burry continued pushing management through letters and media interviews. Engagement with the company remained shallow. The urgency grew. Another letter went out to the board late in August, written with sharper conviction. Insider trading alerts animation. Soon after, several GameStop directors began purchasing shares themselves. Whether coincidence or response, it signaled movement inside the company. Excel spreadsheet animation, numbers updating live, trading patterns became the focus. He watched for signs of buybacks, even studying timing windows when companies are restricted from purchasing shares. Using spreadsheets, he tracked repurchases in real time, carefully measuring ownership percentages, remaining just under regulatory thresholds. private jet silhouette flying west. Executives arranged to travel to California to meet him. But before that meeting happened, another figure entered the story. Ryan Cohen. Two investors talking in silhouette, calm tone. Their conversation lasted hours. Mostly, not about GameStop. Both avoided forming a formal group under securities rules. What stood out was patience. Cohen described taking large positions and waiting, unbothered by short-term noise. To Burry, he seemed unusually disciplined, even reminiscent of legendary long-term investors. Corporate meeting room visuals. In October 2019, he finally met GameStop's leadership. The meeting was cordial, but unremarkable. Progress felt slow. Share count animation shrinking. Still, pressure from activists and investors led to action. During fiscal 2019, GameStop repurchased a massive portion of its shares. More than a third of the company retired at prices near historic lows. From a capital allocation standpoint, it was extraordinary. And yet, the stock barely reacted. Volume bars rising dramatically. Trading volume stayed unusually high. Short interest remained elevated. Despite structural changes, the market showed little enthusiasm. Even as board members changed and new executives arrived, the price continued to drift. March 2020 pandemic visuals, empty streets. By early 2020, the world shifted. The pandemic arrived. GameStop hit new lows. Board reshuffling continued. New directors with experience from retail and gaming joined, hinting at a possible strategic pivot. SEC filing animation, Form 13D, then came a major turning point. In August 2020, Ryan Cohen's firm filed a Form 13D. Unlike passive filings, this signaled intent to influence management directly. The market noticed. Shares jumped sharply. Millennial retail trader imagery, phones glowing. Cohen's age aligned almost perfectly with a new generation of retail investors. At the same time, Chewy, the company he built, benefited from pandemic trends and rising online commerce. Momentum began shifting. Technology transformation visuals. In November, Cohen sent a public letter urging GameStop to evolve into a more technology-driven company. Inside Scion, the reaction was mixed. Some ideas felt speculative. Others seemed already underway. For several days, the stock barely moved. And then, momentum began to build. Stock chart rising slowly. After more than a year holding millions of shares, Scion exited by the end of 2020. The position had lasted over 16 months. For much of that time, lending shares to short sellers generated significant income, a quiet but meaningful component of the trade. Fades slowly to black. The stage was set. Pressure had been building for years, and soon, the market would discover GameStop in a way no one expected. Stock chart slowly rising through late 2020. By the end of 2020, the position was closed. After more than a year holding millions of shares, the average cost sat just above $3. As momentum finally began to build, Scion exited around the low teens. At the time, nothing seemed extraordinary. Short interest remained extreme, but it had been extreme for months. Volume was rising, yet the underlying business still carried heavy execution risk. Investor notebook, reflective tone. Looking back, he admits something simple. He understood the company deeply, but underestimated what the market itself could become. Activist wins had already piled up. Massive buybacks, board changes, asset sales, all concrete victories, and still, the price had barely moved. So when a new technology-focused vision appeared, it felt less certain than the progress already achieved. That moment became the exit. Calendar flipping, portfolio liquidation visuals. At the same time, outside pressures mattered. Large client withdrawals forced selling across the portfolio. Taxes were due. Assets under management shifted. So through late 2020 and early 2021, he watched from the sidelines. Sudden breakout, dramatic stock surge. About 50 days later, GameStop transformed. The stock surged violently, breaking out of the teens and racing higher on massive volume. Hundreds of millions of shares traded in a single day. For a company with a relatively small share count, it felt surreal. Call options chain flashing across screen. Something familiar reappeared. Unusual call option activity. He had noticed hints of it back in 2019. Now the scale was completely different. Volume exploded, both in shares and options. Digital trading communities, phones glowing. Thousands of retail traders began buying call options simultaneously. Online discussion amplified momentum. The opposing side of those trades, market makers and professional desks, were forced into a difficult position. And this is where the mechanics changed everything. Simple animation explaining delta. When market makers sell call options, they often buy shares to stay balanced. This balance is called being delta neutral. Delta measures how much an option moves relative to the stock price. Graph showing slope increasing. But another force, gamma, measures how quickly delta changes. When traders collectively buy huge volumes of calls, dealers become short gamma. Maintaining neutrality becomes harder. To stay balanced, they must buy more shares. Multiple arrows converging. Upward pressure. If many dealers need to buy at the same time, the buying pressure feeds on itself. That feedback loop is known as a gamma squeeze. Retail demand creates options pressure. Options pressure forces stock purchases. Stock purchases push prices higher, which then forces even more buying. News headlines flashing. AMC, Tesla, Hertz. The success of GameStop's move didn't stay isolated. Similar dynamics appeared in other heavily discussed stocks. Momentum spread quickly through markets and social media. What began as a single situation turned into a broader phenomenon. Slow fade to black. And somewhere between analysis and hindsight, the trade that had taken years to build became the one that escaped. Historic trading floor imagery, railroad-era illustrations. Watching the surge unfold, he realized something unusual was happening. This wasn't just a rally. It resembled a market corner, a situation where investors accumulate enough supply to pressure short sellers and drive prices higher. Historically, corners were associated with early stock market manias, long before modern regulation. Online forum visuals, glowing screens, anonymous usernames. But this version looked different. Online communities openly encouraged call buying and collective pressure on short positions. The movement carried a sense of rebellion. Retail traders versus Wall Street. Ironically, Wall Street funds battle each other constantly. But this time, the narrative felt populist. Legal balance scale animation. If a hedge fund had coordinated a similar multi-week gamma squeeze, it likely would have crossed legal lines. If a small group of wealthy investors had attempted it directly, the same risk would apply. But spread across thousands of independent participants, coordination became impossible to enforce. And within that distributed structure, the corner remained technically legal. Fast-moving social media visuals. The momentum spread rapidly. Pandemic lockdowns gave retail traders time and attention. Stimulus payments added fuel. Voices like Roaring Kitty and Ryan Cohen amplified focus. And suddenly, the phenomenon scaled beyond anything previously seen. Overstock-era archive visuals, lawsuit documents blurred. The topic of naked short selling resurfaced. Burry had encountered similar accusations years earlier during another investment. But his view here was different. He believed most of GameStop's extreme short interest came from legal trade structures, not widespread naked shorting. Simple chain animation, stock lending loop. Here's how that worked. One investor lends shares to a short seller. That short seller sells to another buyer. That buyer may lend those shares again. And the process repeats. Layer upon layer of synthetic exposure builds, all properly recorded within the system. During normal markets, this structure functions smoothly. Volatility spike animation, system stress. GameStop wasn't normal. The gamma squeeze forced massive buying at the same moment that layered short positions needed to unwind. Dealers, temporarily allowed to carry naked short exposure, struggled to keep pace with the speed of events. The system became overwhelmed. Panic buying replaced orderly trading. Share scarcity visual, shrinking supply. Professional investors scrambled to locate real shares. As supply tightened, urgency grew, and prices accelerated beyond traditional expectations. In his view, naked short selling wasn't the main driver. The true force was the sudden unwinding of complex legal market structures under unprecedented pressure. Fades slowly to black, a perfect storm of retail momentum, options mechanics, and layered exposure. A moment the market had never quite experienced before. Montage of soaring stock charts, social media clips, and headlines. Looking back, the great short squeeze contained everything at once. Spectacle, humor, chaos, and tragedy. For a brief moment, markets felt like theater. NFT artwork flashes, luxury watches, sneakers. By mid-2021, the energy shifted. Meme investing began to look less like rebellion and more like a mainstream strategy. Digital collectibles surged. Speculative assets of every kind climbed. Some companies raised billions while enthusiasm peaked. GameStop itself sold over $1 billion in stock at elevated prices, a rational move from management. But beneath the excitement, he feared many retail investors would be hurt when momentum faded. Interview camera setup, soft lighting. After staying silent for much of the frenzy, he chose to speak publicly. Not to celebrate, but to warn. Years earlier, during the housing bubble, he wished he had warned more people sooner. This time, he tried. Media cameras flashing, brief awkward smile. The message didn't always land smoothly. The persona, Burry, followed him everywhere. But timing mattered. Some meme stocks peaked soon after. Others declined over the following years. By 2023, much of the speculative wave had faded. Modern GameStop storefront mixed with digital graphics. And yet, GameStop endured. By 2025, the company still carried a multi-billion-dollar market value, a number that would have seemed impossible years earlier. Had the position been held through the entire saga, its value might rival decades-long successes like Avanti. Ryan Cohen leadership visuals, technology transition imagery. Under Ryan Cohen, the company evolved. Not perfectly, but steadily. A stronger balance sheet, more digital focus, fewer physical stores, free cash flow returned. The business became something different from what it once was. Historical charts blending into book pages. For Burry, the entire episode became more than a trade. It became a foundation, a reminder that history shapes analysis and that markets constantly rewrite their own rules. These reflections were not just about one stock. They were meant to serve as reference points, lessons that inform future ideas. Slow sunrise over horizon. Every cycle leaves behind something valuable. Sometimes profit, sometimes regret, often perspective. And for those willing to study the past, the story of GameStop becomes less about hype and more about understanding how markets evolve. Fade to black. The lesson wasn't just the squeeze, it was the journey and the history written along the way.